Welcome to Amazon Legends, where we have real stories about making it big on Amazon. Our guests are CEOs of large companies and entrepreneurs who became power sellers, also providers specializing in helping sellers, aggregators that acquire sellers, and former Amazonians will give us an insight from behind the scenes. Here is your host, Nick Urison.
Welcome to another episode of Amazon Legends. I'm so looking forward to this episode, and you're going to know in a second why. So before we get there, I want to tell you about my next guest. So I've seen many people who start businesses, but I've never heard anybody like him why he started his Amazon business. Because he grew up on a farm, he became a CPA, and when he was a CPA, obviously he likes numbers and he was consulting businesses. And in order to become more qualified and make more money or whatever, he decided to take a course to study daily. And his daily schedule was 4 a.m. to 7 a.m. So he would get up every day, 4 o'clock, study, and then, of course, his day would start. So guess what? He finishes his study, but now he's got this habit of getting up at 4 o'clock in the morning every day. And then he says, you know what? I have all this free time. I think I'm going to start a business. And that's what put him on Amazon, and he became an Amazon seller. So somebody deciding to fill his time slot between 4 a.m. and 7 a.m. with nothing that resembles like sleep but work, and then change the lifestyle. That's who you're looking at. So today, he is a mid-7-figure seller with 3 brands in US, UK, and Mexico, as well as Walmart. And in addition, he has a podcast of his own. He's the host of Firing the Man podcast. He loves spending his time with his wife and 2 boys outdoors. As if all this is not enough, he is also a fanatic in beekeeping and woodworking. So with that, everybody, meet my guest, David Schomer. Welcome to the show, David.
Thank you, Nick. Thank you. And thanks for that introduction. I appreciate it.
Well, I mean, I meant everything I said. It's 4 a.m. to 7 a.m. You know what I'm doing at 4 a.m.? Usually that's around the time I'm going to bed.
That's right. That's right. The life of an entrepreneur. So
exactly. So David, obviously you're a CPA, you're a numbers person, but you're an entrepreneur and you are an Amazon seller. So we're going to talk about today one of my favorite subjects, data-driven decision making. Because everybody talks about data-driven decision making, but when it comes to data-driven decision making, there is usually a lot of ideas that people share, what data to look at, where do you get it, and then how do you, creating pivot tables and blah, blah. They talk about all that. But there is really no methodology behind decision making based on that data. So today we're going to bring the two together. We're going to talk about what data we're looking at and what decisions you are making based on what that data is showing. And of course, this is not a black and white decision. This is almost like those graded bar charts where it starts, dark red, and then it starts to get close to purple, and then ultimately becomes white. So there's different degrees of decisions that you make based on what the data is showing. So that's the nature of the conversation we're going to have today. So everybody listening, stay tuned. And by the way, for those who are wondering, oh my God, another ACOS, TACOS conversation, we're not talking about ACOS, TACOS. This is much, much more meaningful than those metrics that will help you with your operation. So with that, let's dive right in. So where do we start, David?
yeah, absolutely. I think it starts with financial statements and a little bit of a shift in mindset on what do I use my financial statements for. I think a lot of people, myself included, when you get into this business, financial statements are simply something that you need to have for your tax accountant at the end of the year. And that is true. However, they are a very important tool that we use in our business on a monthly basis. And I can go into some of the aspects on financial statements, but I would say first things first, if you are not getting bank reconciled financial statements from your bookkeeper, you ought to. I have a habit of logging on to my Amazon seller app and I look at revenue, and that is helpful. However, that is a vanity metric, and I'm in the business of producing net income. And so that's something that I pay very close attention to. And as businesses grow and expand, having your financial statements grow and expand with you is very important. And so I have what I like to call kind of the seven commandments of great financial statements. And I'd be happy to go through those if you would like.
Yes, absolutely. So I'm gonna ask you a dumb question. Obviously, I know the answer to it, but just for some of my listeners, I just heard you say that you are in the business of producing net income. So net income means the net cash left in your pocket, right? Out of the operation.
Yep.
Isn't that your Amazon deposit? Because they take off everything and they pay you what's left. Isn't that your net income?
No, it is not. So there's going to be a lot of things that are left out of that. First thing is going to be your operating expenses. So if you have a team, payroll, that's not going to be included in that. That would be something that you need to have leftover cash for after your Amazon deposit. Subscriptions, things like that. Those are all operating expenses that are not going to be in there. And I would say within the Amazon payments, there are some very sneaky expenses, and we can get into these a little later in the episode, but they're not necessarily expenses that you're swiping a credit card for or you are writing a check for. They're deducted out of your payments. And I think that understanding what is Amazon charging me for and how can I better manage that is going to make you a better operator altogether.
Well, I mean, this is so right. And those are the things that will kill you because they eat into your margin. Yeah. I'm going to tell you, though, two biggies that come out of that, I should say, not come out, but that skew that net deposit, making it far from being net income. First and foremost, the cost of the merchandise you sold, right? All they are paying you is your top line minus their commission, minus FBA fees, minus advertising. Well, if you sold $100,000 and you received $20,000 net deposit, well, what does that mean? Well, it doesn't include the merchandise. You still have to pay for the merchandise you sold, right? Number one. Number two, what may also happen, this is not for every seller, but Amazon holds on to some of the funds. They call it reserve, right? So if they paid you, you sold $100,000 and they made a $20,000 net deposit, well, maybe they held on to $30,000. So really your net deposit should be $50,000, which still doesn't mean that's your net income because it doesn't include the merchandise. But more important, you have things that have nothing to do with Amazon that you pay out of your pocket, like you mentioned, the payroll and your rent, your warehouse, your insurance, you name it, all those things. Those are the things that I always warn people against. Don't just look at your deposit. Deposit means nothing. All it is just you got the cash, but don't look at it as a financial indicator. So would you agree?
Absolutely, you're spot on, and that was one that I missed was the cost of your merchandise and freight. That typically is going to be 30-40% of your revenue, and something that you absolutely don't want to forget about, because if sales go well, you're going to need to have money left over to reorder that inventory.
Okay, so now since you are a CPA and you've been an Amazon seller long enough, tell us, what is the best way to structure your financials? Because as you know, Amazon has so many line items. So what do? You look at every single one, and because you want to be able to like consolidate a number of them and say, look at this. So give us your way to structure it so that it's not clutter. We're not drowning in numbers, and also tell us what are the metrics that come out of it, because numbers are not metrics, and metrics are totally different. So what metrics come out of those financials?
Yeah, absolutely. So I think one rule of thumb that I use when I'm deciding whether I want to include something or not is the phrase, what gets measured gets managed. And there are certain things that you may not be managing. However, let me give you an example. Inventory storage, not long-term storage fees, but just inventory storage. This is something that we wanted to take a really close look at and see, are we losing regional coverage if we have, say below 30 days of inventory on hand? And at what point do you have diminishing returns? That was something that we wanted to manage. Therefore, it needed to be a line item on our financial statements. And so that's something that when you're making a decision on should I include this or not, one, ask your bookkeeper, ask your CPA. Do you think this is something that would be helpful to track? But that is what I use as kind of the overarching theme of our financial statements. If it's not something I'm going to manage or make a decision based off of, then I'm going to put it in other miscellaneous business expenses and move on, or have an account that kind of describes what that fee is. The other thing I would say, and as Amazon has made international expansion within reach for a lot of entrepreneurs, I think that breaking out your financial statements by marketplace is critical. And we do this, one thing that I really like to look at is gross profit after PPC spend. And I'll get into this in a little bit, but PPC behavior is very different across marketplaces. For instance, I've got a brand right now over in the UK where we were having some issues with inventory. We were going to stock out, and we turned off PPC, which is kind of a no-no. And we had 100% organic sales on that particular product. Now, in the US marketplace, if we would have done that same thing, our sales would have really fallen off. And so when we're making decisions on PPC spend and PPC allocation, it's really helpful to have that broken down by marketplace. The other reason, and this is just to ensure that you end up with correct financial statements, is on currency. You're often dealing in different currencies, and breaking those out separately helps kind of keep things straight. When you get your credit card statement back at the end of the month, and you have all kinds of PPC spend from different marketplaces. And so I would say broken down by marketplaces is something that's very important. The other thing, and this could be something that you are getting from your bookkeeper, this could also be something that you do after the fact, after you receive your financial statements, is stating everything in dollar amounts as well as a percentage of revenue. And let me give an example on this. Say you get your financial statements back, and in the month of November, you had $2,000 of refunds, and you ask yourself, is that good? Well, what is it as a percentage of revenue? Well, if you had $10,000 of revenue, you've got a 20% return rate, and you've got a big problem. Now, if in the following month you have $2,000 worth of refunds, and say you have $200,000 of revenue, well, now you have a 2% return rate. And for any brands that I manage, that's very well performing. And so I think that that's something that's really important, is expressing things as a percentage of revenue, because it really allows you to pick up on some trends, especially if you have a seasonal brand. For a brand that really peaks in November and December, simply analyzing dollar amounts is not as helpful as analyzing the percentage of revenue, because you can really see the net impact of the dollar amounts expressed as a percentage of revenue. Did that answer your question?
Yeah, I mean, I want to complete the whole structuring, but something you said is so key. So I had this is last year when aggregators were busy acquiring all the brands, and of course, after COVID, situation changed, but before COVID, immediately after COVID, it was all feeding frenzy as far as aggregators, brands being acquired. And I had the chief financial officer of one of the largest aggregators. And he said something so concise and so significant, I always repeat it. He said, percentages are the language to help us interpret financial performance. I just heard you say something similar. He said, percentage of revenue will tell you more. And ultimately, that's what I will say. If your financial metrics are dollar values, that's not a metric. If the financials that you are tracking are percentages of revenue, that's a metric. So that's the way to separate. And then you have to decide, okay, what would make sense? So from everything that I heard from you, what you can measure, you can manage. Then the question becomes not what metrics, but what is it that you would like to manage better, right? So, well, obviously you want to manage your advertising spend better. That doesn't mean how much you're going to spend. That means it's a percentage of revenue, right? So that's called tacos, which we said we're not going to talk about, but it's about easiest example to give people. But you definitely want to have a metric that says your refund rate as a percentage of revenue. And then you need to look at your storage, because storage is going to eat you alive if you're keeping too much. And of course, you're going to be spinning, overheating. The operation will overheat if you are not carrying enough. So that's a metric. And another metric is your FBA fees. And I'm not talking about storage. I'm talking about your order-based FBA fees, how much you pay for each order. So that's another metric. I tell you another metric that nobody really cares about, but it's so important. Your promotion rate. Because now you're laughing, you see, you know what I'm talking about. So what happens is we set up these, what they call unit economics, and we say, okay, we're going to sell it for $50, and then we're going to spend $6 on FBA, and that's great. That's like 12%. And then we're going to pay 15% to Amazon, so that's with 27%. We buy the item for 30%, so we are up to now 57%. And then we have advertising. Okay, our tacos is around 15%. So now you are ranking up, and then ultimately you say, okay, we have a clear 15% net margin. No problem. Well, guess what? You're on a discount and offer 15% off.
Yeah.
Right? So what is that composite promotions, discounts you offered is a percentage of your gross top line throughout the whole month. Because usually you post to your books the net revenue, and that promotion, your discount that you granted, it disappears and you never know. And then the next thing that you are thinking is, oh, wait a minute, our sales were so much and our FBA is now 18%. So what happens? Something is wrong, right? So percentage of the promotions, I would say, is another metric. So tell me your take on all this, and then add to it. Feel free to add more to it.
Absolutely. Yeah, I fully agree with you. And a lot of the things that you listed there were Amazon fees that you likely are not writing a check for. And I want to talk about this a little bit and how we manage this in our business. So you had mentioned tacos. We have a acronym in our company called AFCOS, and that stands for Amazon Fee Cost of Sale. If you look this up on Google, you probably won't find anything because we literally made it up. But here's the rationale behind it. If you sit in on a mastermind or you go to a conference with a lot of Amazon sellers, a lot of people are going to talk about Amazon fees, and they will likely be complaining about how Amazon continues to nickel and dime and hit sellers with new types of fees. We saw this last year with inventory overage. We're seeing it rolled out this April with the new low inventory penalty. And what I've come to the conclusion of is that's not going to go away. And so if they're going to start charging us these fees, we really need to have a good understanding of what are they and can we manage them. And so there's a report within Amazon Seller Central called the Amazon DRSR report. It's a reconciliation of your payments. And this is where we really like to go and look at what fees are Amazon are they charging us, and can we manage these? So within here, you're going to see long-term storage fees, just monthly storage fees. If you have removals or disposals, that's going to be caught there. Your coupons that you had mentioned, and all of those are things that you want to have eyes on. And what we have found in our business is, and I promise this isn't going to be a discussion on PPC or tacos, but for those people that have actively managed a brand, to take a tacos from, say, 20% to 15% is really challenging. And oftentimes you're going to see a decline in your sales. However, to take an AF coast, say from 8% to 3%, that's very doable. And it kind of goes back to what gets measured gets managed. And so I use the example of 8 to 3%. That is something that we did on one of our brands. We had noticed that storage fees were incredibly high for this particular brand. We readjusted how many days of inventory we were stocking. And we also noticed a couple other things, and this goes back to the percentage of revenue. This brand was doing really well in Canada. However, the FBA fee as a percentage of revenue was much higher in Canada relative to the US. And this let us know that, hey, maybe we need to check into a remeasurement. Maybe they don't have the right measurements. And we did. And in fact, that fee came down. And so this is something that we're looking at AF costs on a monthly basis, and we will never get that to zero so long as storage fees are included in it, and that's okay. However, we want to do our best to manage that number as best we can and get it as low as possible, or at the very least, know what Amazon is charging you for. It's a really interesting way that the payments work out with Amazon because you're not writing a check for them. You don't get an email from Amazon saying, hey, by the way, we charged you $1,200 for an inventory overage fee. It just kind of comes out of your pay. And if you're not conscious of that, it can be many months later when you're looking at your books, wondering where all your money went. And so I would say that, Amazon can be a tight margin business. And so being aware of what those costs are and being aware of how to manage them is really important. So I would say AF cost is one that is critically important.
How do you calculate AF cost?
So we're going to that DRSR report, and anything that is so any storage fee, long-term storage fees, just regular storage fees, coupons, discounts, and there's a whole bunch of other things that we may not have been hit with, but I think people would be surprised if they looked at their Amazon DRSR report for the last couple payments. And this is something that has become a regular document when we're doing financial reporting. And I like to put my eyes on it all the time because things do pop up. On this DRSR report, there's a line item for other Amazon fees, which is not descriptive at all. And so there have been times where we've needed to file cases and say, what is this? What is this mystery bill that we're being charged for? And it's really interesting to get that feedback from Amazon. And so I would say that if you're a prudent business owner, you're likely reviewing your credit card statements once a month, at least. You're reviewing all the checks that you wrote for the month. This is in line with that part of being a prudent business owner, is understanding where that money is going. And so we do that through monitoring the AF costs. You can call it whatever you want, but it's these sneaky fees that seem to be becoming more and more important in whether a product's successful or a failure, probably within the last year to 18 months.
Okay, so this is actually very much similar to the way I categorize, but before that, I want to say for our listeners, so what you are talking about measuring is go to that report, download it for the period that this applies, your analysis applies, and then take the total of those fees and divide it by your top line. And then look at the calculation. That's going to tell you all those fees that are in that report as a percentage of revenue. How much is that? And I agree with you. It is no big deal to bring that down from a high number to low number, because the reality is you are probably being charged those fees because you've done certain things, you've taken certain actions that really didn't, without thinking what it's going to do for you, then it's going to be a high percentage. So the way I see this is, as far as my P&L, what I like to separate is item-based fees, storage, advertising, Amazon commission, and then I call them everything else. And you're referring to the everything else, and that's in the ERSR report.
I am, and what I'd encourage everyone, if you do have an everything else bucket, is know what's in that bucket. It's so critically important. And I think there's a lot of people that have been selling on Amazon for years that the payment just shows up and it is what it is. I think that if you want to get your black belt in selling on Amazon, you got to understand the Amazon fees piece of it. And that number may be zero or approximate zero, and that's great. But what I found...
Never zero. I guarantee you it's never zero.
What I found when we dug into it on one brand, and we were like, whoa, there's a lot more here than we were aware of. This is now a standard practice. We're going to look at this every single month, and we are going to monitor it and measure it and see if there's opportunities for us to do a better job here. So,
I tell you a story, nothing to do with Amazon, but to do with e-commerce, and it's about UPS and FedEx. Because I'm very much numbers oriented and I'm always process driven, so when I started handling e-commerce, of course, using UPS or FedEx meant that all the fees that you were paying for postage, so to speak, it was never like USPS where you would prepay. It was always billed. And then, of course, their bills would be pages and pages if you're looking at paper bill. If it's a CSV file, it's hundreds and hundreds and hundreds of lines. So I'm not one of those people who will just pay a bill. If it gets deducted from something, that's after the fact. But especially if I have to write a check, there is no way I'm posting a bill to my payables that I have to write check for without understanding every penny. So I created this extremely complex auditing system. All we would need to do is just download the CSV file, upload to it, and then bang, it would tell you, okay, this was your rate, and this is what you were charged. Well, actually, I take it back. This was your quoted rate. This is what was captured during the label, when the label was issued, and this is what was billed. It was totally different. So within one billing period, which was weekly, and how much we spent was during that week, I don't remember now, but it's as a percentage, I found about $4,000 worth of overcharges. And that represented somewhere around like 12% of the entire bill. And I thought, okay, maybe there is a reason. Audited another one and another one. Guess what? On every single bill, there's this kind of stuff. And then I called the UPS people and I said, you are thieves, nothing but thieves. And of course, they were all offended. I said, look back so many years. This country has gone through several recessions. What happens during those recessions? Companies go down, mostly small businesses, they don't have the cash, and they go down, and they have all these difficulties. As yet, UPS, FedEx, you guys keep reporting profits. Explain that to me. And you are always reporting growth. Explain that to me during recession. How do you pull that off? I said, I will tell you how, because you are so sophisticated and you have enough cash to build these elaborate systems that systematically apply additional charges and that collect that from small businesses who are not capable of auditing. And you know what? Both UPS and FedEx, God forbid you are late 3 days on your payment, their collections department will descend on you like an eagle is about to pull up a little fish, and they can say, we're gonna all the threats and everything, because they know that this is how they're making their money, and your receivables are the most valuable asset. So they want to collect every penny of it. So I said, this is not going to fly with me, and you're doing this on purpose. And first of all, I said, I want a refund for all this. In addition, and by the way, they don't issue refunds either. No refunds. Oh, we don't give refunds. No refunds. I said, if you don't want to give refund, no problem. That's the end of it, but I'm not going to leave it here. I'm going to take this up with the FTC because you're doing this deliberately. So I ended up getting not a refund, but also avoiding all the charges. You know how? They assigned somebody to me to study all the overages. And they said, look, we would rather not charge you these, but avoid them in the first place. And we're going to show you how to avoid. So we're talking about Amazon, and I love Amazon. Amazon changed many lives, but it's the same thing when you're dealing with companies that are all automated. They have these automated charges that somebody somewhere decides, and they get applied, and before you know it, Amazon is the best thing. It just gets deducted from your payment, and nobody has to worry about it. So, I mean, you are so right. You need to look at those and see where the money is going, and then put a stop to it, because you can. Those are all discretionary.
Absolutely. And I think this is kind of the unsexy part of entrepreneurship, is going through the bills, going through what you're being charged, and asking, is it legitimate? And I think that's a great example. You know, you would assume, oh, UPS is a big company, they have my best interests at heart, or FedEx or whatever. Not always the case. And the example that you brought up, I think, is far too common. And gosh, it'd be unbelievable to know how many of those things get unchecked. And so I think for people and to listeners of your show who we want to be successful, this is something that I would probably set aside at least 5 hours a month to go through everything and ask questions. What is this? You know, and it may be, do I need the subscription anymore? It may be questions like that. It may also be, hey, this bill seems awfully high. Let me dig into this. And so, really good examples there. There's two other things I want to mention as we were talking about financial statements before we kind of drill into on a per product basis, which I think is also very important. One of the things is to calculate sellers' discretionary earnings. To do that, you would take net income plus interest expense plus depreciation, amortization, and there are resources out there that can help you calculate this. But it essentially gets to a good proxy for cash flow. If you have any personal expenses or a company vehicle, you would deduct that out of, or you would add that back to net income. But what this does is it gets you to an approximation for the value of your company. So you would take this number, you'd multiply it. If you're running an e-commerce company, probably somewhere between 2 and 4 these days. That does change. And then you'd add on inventory. And that gives you an approximation for what could I sell this for. And the reason I mention this is it is helpful to know how much is this asset worth that I'm building. However, I would also add from just a mindset. When you're growing, say if you're growing 100% year over year, most people that haven't run a business would say, oh, you must be cash flow rich. And I can tell you, as somebody that has grown businesses 100% year over year, you will never feel so poor because your cash conversion cycle is very long. You cannot run out of stock, and you place your order. You may not have recouped all of those profits yet to go and make your reorder, especially if you're going out of China. And it is when you're sitting there cash flow poor, it's kind of helpful to know that, well, at least I'm growing this asset that's worth something. And I like to look at that number, and from like a mental health standpoint, it's been really helpful to look at that every month. And it's also helpful to see, okay, my business value went down from last month to this month. Why? And so that's something that there's really good resources out there on how to calculate SDE. This would likely be something that your bookkeeper would not do or would do for an additional fee. However, I think it's really, really important to do.
Give us the definition for that. Seller's discretionary income.
Yes, I've got it pulled up right here. I'll share with you how we calculate it at our company. So this is going to be, we're going to start with net income, which is going to be the bottom of your P&L. And then here are the adjustments that I will make when I'm calculating this. So interest expense, we have a holding company, so I add back management fees. Any intercompany, if you have your kids on payroll or your wife on payroll, if they're working in the business, I think a good thing to ask is if this were to change hands, would this still be incurred? Software expenses are something that can be added back. Any one-time items. So if you get sued or you hire a contractor for a one-time project, that would be a one-time expense. Owner health insurance and owner's compensation. So that gets you to seller's discretionary earnings. And when you have that, you add up the last 12 months, and that will get you your trailing 12-month SDE. And that is what you can do. You can multiply that by, I would say, I always multiply it by 3 because it's just helpful. That number is, you can go back and forth on multiples. What multiple is my company worth? You can figure that out when you go to sell. I always like to guess on the low side here to be conservative. But you would multiply that by 3. That's what I do. And then I add back my inventory. And that's an approximation for what your business is worth. And I'm not as concerned about the number. I am concerned about the movement of that number. Is it going up or down? What things am I doing in my business to make it worth more? What things am I doing in my business that make it worth less? And, when you're a business owner, there's 2 types of compensation. There's the cash flow that you get from paying yourself on a regular basis. But a huge chunk of the value that you're building is what that asset's worth at sale. And that's something that when you're in the trenches or you're growing very quickly, which is a good problem to have, I find to be an incredibly helpful metric to look at on a monthly basis.
I mean, this is so key because it takes all the clutter out. Because what you are describing is, first of all, okay, let's go back. Start from the beginning. Your net income.
Mm-hmm.
In order to calculate your seller's discretionary earnings, you have to be able to start with an accurate net income calculation in the first place.
Mm-hmm.
And a lot of the times that's not the case. So
Yeah.
you're starting right from the beginning with a contaminated number, right?
Yeah. I think that goes back to one of my earlier points is get bank reconciled financial statements. It's just something that is, there's all types of services out there. We do ours internally. However, there's all types of services out there, and it's something that's critically important to your business. And if you're going to spend time to do analysis, make sure you're doing analysis on solid numbers, numbers that can reconcile back to a bank statement. And so this is something that before you worry about SDE, make sure you have solid financial statements. And when you're talking bank reconciled financial statements is what you would be asking for. And there's a lot of firms out there that do it. There's a lot that specialize in servicing Amazon sellers. And I think that is critically important.
I have a question for my listeners. Are you experiencing cash flow challenges with your Amazon business? Well, silly question. Who is not, right? So let me introduce you to Viably, a unique solution tailored for Amazon sellers and e-commerce enterprises. By connecting your Seller Central or Shopify account, you can promptly access funding along with a variety of financial tools, all for a flat fee. It's as simple as that. And for my listeners, they are offering an extra $1,500 in funding for eligible applications. Start your quick and easy application today at runviably.com/legends. And that's runviably.com/legends. Well, I mean, it all starts with being able to take that settlement report that comes out every other week with, if you are doing really well, it's hundreds and hundreds of line items. Of course, for each order, there are several line items, and then there's all the, what we call the everything else. And when you add them together, and with their reserves and reimbursements and clawbacks and the clawback fees and put it all together to be able to say, okay, we sold so much and we paid so much in expenses and commissions and everything else, and this is what's left. That's already a huge task, because it will call for serious analysis. There are tools out there, that one of them that I like very much is A2X accounting, and they automate the whole thing. They plug into your Seller Central and then pull it out, and then they just render an invoice as if you're selling to Amazon, averaging the price for every year, because you may be selling at different price points. So that will help that, but that's not the end, because then comes the next challenge, and that's the inventory accounting, right? So how do you manage that? You need to have the systems and the configuration that will help you do that, right?
Yeah, absolutely. So we use a spreadsheet or Google Doc that anytime that we reorder from a factory, we would put the unit cost. And what we do separately is we will look at freight per unit. So on our financial statements, freight is one line item, and cost of goods sold is only going to include the unit cost of our item. And so as those are updated, we update our spreadsheet. And I like to look at, and let's just use an easy example. You buy 100 units and your shipping charge is $100. So your shipping cost is $1 per unit. And say you buy those units from your supplier for $5 a unit. That $5 unit cost plus $1 shipping cost makes $6. And that's what I call fully loaded cost of goods sold. And so I use a tool on Helium 10 called Profits. When I'm entering in to Profits, I like to use the fully loaded cost, because it's good to know how much that shipping cost is, or how much the unit cost is, but you have to ship it. And forgetting about that cost is critically important. And so when I'm doing analysis on profit, which, why don't we get into that? I am always looking at fully loaded cost. But just to kind of round out the conversation on bookkeeping, as an entrepreneur, the typical rhythm, at least this is for me, is you'll be charged with a task. And the first thing you'll say is, okay, I'm going to do this on my own. And you'll maybe do it on your own for 2 to 3 months. And you'll realize, oh, I should probably outsource this. I'm not very good at it. And I would say that this is one of those items that if you have a background in accounting or finance, or feel very comfortable with QuickBooks or A2X or a platform like that, go ahead and do it yourself. However, I do find this to be a very valuable thing to outsource. If you have 10 hours a month to spend on financial statements, I think you'd be better off analyzing and making decisions based off of financial statements that somebody prepares for you, as opposed to spending that 10 hours putting together your own financial statements. And so that's just my opinion. But I was a retired CPA, and I found it to be a better option to outsource it and spend my time just doing the analysis.
Yeah. Well, I mean, listen, this is absolutely, you can do it yourself. So you describe, you say, oh, I'm gonna do it myself. And then there are those right from the get-go, they say, oh, no, I'll get somebody else. I don't want to. Okay, there's a third type. I don't want to do anything with this. It's not priority for me. There's also that group, right? I mean, this group is the most careless because they say, I don't have the time or the desire to account for what my business will do, but at the same time, I'm going to write checks and buy merchandise without knowing, where it's going to go, right?
Yeah, this is going to sound dramatic, but I truly feel this way. To sustain life, right? You need food, water, shelter. So to sustain life of your business, one of the things, food, water, shelter, needs to be financial statement analysis. It just has to be. And if you're not good in that role, or you find yourself procrastinating a lot, hire somebody. Hire somebody to do that and help you with it. But I find this to be, if I look at my track record, and I've had plenty of businesses that haven't taken off, one of the missteps is not understanding the numbers and not digging in enough and spending enough time. And it can be boring. It really can. But I think it can also be fun. When you watch your business grow, that's fun. When you see the fruits of your labor materialize, that's fun. And one of the ways I think you can find growth and be a better operator is to spend the time on your statements.
Yeah, I mean, absolutely. This is key. The part that I want to clarify also, David, is the inventory accounting. Yes, when you are setting your pricing, you want to look at the fully loaded cost. But that's not what I'm referring to. You know what I'm referring to is this. Let's say that you sold 1,000 pieces. And let's say that you have done everything to take that settlement report and bring it down to the line item level and grouped it, and you saw all the buckets, advertising, blah, blah, and the everything else. You're looking at as percentage. What is missing in that picture? It's cost of the inventory that was sold, that's associated with that settlement report. How do you know that? A lot of the sellers don't know. What they do is they buy merchandise, they pay the bill, they post it as a cost, and it sits on the books as an expense. And then, as the sales come in, you see where I'm going with it. That's the challenge.
I do, yeah. And so what you're getting at is accrual-based accounting versus cash-basis accounting. And I'll make this pretty quick. I don't want to put people to sleep, but in the instance where you buy it, that shows up as an expense in 1 month, that would be cash-basis accounting. And I find that to be not very helpful. Accrual basis would be when you buy the inventory, it goes on your balance sheet as an asset. And as you sell off that inventory, it gets flushed out of the balance sheet through your income statement by the number of units sold multiplied by your unit cost. And so that would be something when you're talking to a bookkeeper, I want bank reconciled financial statements on an accrual basis, and that would be what you're returned with. And so, yeah, does that answer your question?
Yeah, it does, except that I'm gonna dumb it down.
Okay.
Because as soon as you start using these fancy terms like accrual basis, people don't really, I mean, everybody understands cash basis, but basically the idea is very simple. If you spend $1,000 on merchandise and you put it on your on the shelf in the warehouse, that's an asset. It doesn't matter, forget the accounting basis or systems or anything. Just from logic standpoint, that's an asset. It's like you bought a car. It's not an expense. So that's an asset. So the way you must structure your accounting is, there are two ways to do this. It's very simple. You just have to start with the right one. Set it up in a way that will simply, when you make inventory purchases, it will post it as an asset. And then when you issue an invoice, which is what you will do for a settlement period, then it will deduct the cost of the inventory from the asset and then transfer it to the cost of the goods sold. So that way you will be reducing your asset value and increasing your cost. And then when you pull your P&L from your QuickBooks or Xero or whatever, or your Google Sheets or whatever you are using, you will know that lump sum that sits in cost of goods sold account is the right one, because it will be done automatically. And then you can take that number and say, okay, I'm going to plug that into the full picture, and that's your net deposit, or I should say net income. Then you've got a healthy starting point. Would that be right?
That's exactly right. That's exactly right. And I think you explained that in a very good way. Yep.
Yeah. Okay, cool. You know why I care about this? I made this mistake myself, and I love numbers because it was my early days. I had no idea, and I would get orders, and it was a mess. Okay, so what I heard from you is, so we at the beginning we said that we're going to talk about metrics and we're going to talk about what to do. So a few metrics that we covered were very extremely important. First of all, if you are not reporting it as a percentage of your top line, it's not a metric.
Mm-hmm.
So identify exactly what those are. And the ones that we would recommend is your refund rate. That's a metric. And what you do with a refund rate that starts to look high. And by the way, and something you said, I'm going to repeat it because it's so important. I don't really care about the number, but I care about the fluctuations. So look at it as a trend. What is happening to that number month over month or week over week? So that's what I'm, so if your refund rate is going up, then you have to look at the reasons for refund. And in Seller Central, you'll be able to see that. Another one is your storage, you mentioned. Storage is something that you have to manage as a line item. If the storage is going up, obviously you are sending too much inventory to Amazon, right? So you have to reduce it. And at the same time, you don't want to send too little because then you have low inventory fees. That means that if your storage is too high, look at it. Why? Is it low inventory fee? Is it long-term inventory storage? And then that will determine your action. Another one you mentioned is this, you called it
AF cost, Amazon fee cost of sale.
Amazon fee cost of sale, that I call everything else. Look at what that total is as a percentage of total revenue, and look at what they are. Group them in those individual line items within that big lump sum. Group them and then look at each total and see what they are. There is a good chance you can avoid a lot of them. My UPS FedEx example. And my favorite is, frankly, watching your promotion. Always have that gross. Post the gross as your revenue, and then post the discounts that you've given as a separate expense line item, and then look at the percentage of that. If you find that you are continually giving 12%, like you may be offering 25% here for 7-day sale, Prime Day, whatever, you offer 25%. And then the next thing is you have 5% here, 10% there, and then it averages at 12%. That's an expense at 12%, eating into your margin, right?
Absolutely. Absolutely. Yep.
Yeah. Okay, so there's, or I mean, already financials, and then of course your recommendation is always make it reconcile to the bank, because ultimately that's what it is.
Absolutely. Absolutely. And I think to kind of close this out before we get into product level analysis is do something. Like when you make this observation, do something. I'm going to give a couple examples. If refunds appears to be high, talk to someone on your team. Go look at voice of the customer. See, do we have a sizing chart that's off? Why are people returning this? If you are running promotions, talk to someone on your operations team, or you go and look at it. I think that simply looking at a problem on financial statements does not solve the problem. It's the action that follows. And so when I am looking through financial statements, I have a spreadsheet. We use a task tracker in our business. And any problem I identify, I may not solve it at that moment, but I'm assigning it to somebody to look into, and I'm going to follow up with them. And I think that's critical. Is looking at the statements is important, but digging in and using members of your team, if you do have a team, to dig into those is really important.
Yeah, absolutely. So, David, you wanted to get into item level, right?
I do.
But you know what we're gonna do? We're not gonna do that now. We're
Okay.
gonna do David Schomer part 2.
Great.
Okay. We'll do another episode and we'll get into it, because it's one thing to look at the what I call the, so again, in my system of managing things, you have company-wide metrics and you have item-based metrics. So some of the metrics exist for both. Some of the metrics are specific to company-wide operations and some item-wide. So I think we've done a pretty comprehensive job on the company-wide, and I don't want to rush the item-wide, because that's ultimately what's going to drive everything, because it's all about the breakdown. So we're going to bring you back and get into that there, because the next few minutes I want to spend is the favorite part of my episode, every episode, and I don't want to rush that. So so we'll have a part 2, and then we'll get into there. So right now, what I want to do is I want to peel back the layers of the David Schomer onion.
All right.
And then see what is the real driver that brought you here. So tell me about your background, but what I'm interested in is not your resume. It's about your life experiences. So how did you get to be like, you grew up on a farm, and then CPA, and then entrepreneur. So tell us, when was the first time that you remember that you had this entrepreneurial tendency?
Absolutely. Yeah. I would say it does go back to childhood. So I grew up on a farm in Iowa. And as it relates to e-commerce, we were pretty early adopters of ordering things online. To get a part for the tractor would typically take half a day, and you'd go to John Deere and they would not have the part that you needed. And so very early on, our family started ordering off eBay Motors, and it made me kind of realize that we may not live in a big town, we may not live close to the tractor parts store, but this is within my reach. And because of the mail system, this is a thing. There's something here, and that planted a seed. But in terms of entrepreneurial ventures, I started a pumpkin patch. My dad rented me and my younger brothers some land, and we started a pumpkin patch. And it was something that started small. We'd sell to neighbors and families and friends, but we ran that pumpkin patch for about 6 years, all the way from age 12 to age 18. And by the end of it, we had introduced more than just pumpkins. We were selling sweet corn and all types of melons, and we had scaled it to be pretty big for a bunch of kids. And that was something that gave me some confidence in, hey, you can do this. Being a business owner is within your reach. And it gave me some confidence going into college of, you like business, maybe you should study business. and studied, went to St. Louis University and studied accounting and finance. And out of school, wanted to do something entrepreneurial. I really did, but I didn't have the capital and I didn't have an idea. And I had done an internship at a consulting firm and I had gotten awesome experiences. I got to work on mergers and acquisitions, got to work on a Ponzi scheme, got to work with the FBI, really fun stuff. And I got to see a lot of businesses, some that were doing well, some that were not doing well. And so I decided to go and work with this firm, and I ended up staying there for 7 years. And that's something that I have a podcast called Firing the Man, which may sound disingenuous to previous employers, but it's not. During those 7 years, I was compensated in two ways. One was the cash compensation that went into my pocket, but probably the more valuable compensation was the visibility that I had into business and how business works. And so for people that are maybe thinking about doing e-commerce full time, or don't really like their job, I would pause and ask the question, are you learning, and is what you're learning going to be valuable up the road? And so I really enjoyed my time there and I was learning a ton, but at some point I needed to jump off and go out on my own. And so, as you had mentioned in the intro, I had studied for the CFA exam, Chartered Financial Analyst, which, not to be confused with a financial planner. This was very into derivatives and futures and forwards. It was very quant heavy and took about 4 years to get this designation. And had gotten into a habit of waking up at 4 a.m. and studying until 7 and then going into work, and wanted to do something productive with that time. And so I think I saw a Facebook ad probably of, I call them the Lambros. It's the guys in the Lamborghini that say, come sell on Amazon, you'll be a millionaire overnight. But it just kind of hit me like, okay, e-commerce is the future. I do believe that. And throughout college, I would buy my friends' textbooks and sell them over the summer. And that was a nice source of income. So I had never really left e-commerce. And so decided to start a pet supply company. And I did that for 3 years while I had a full-time job. And that was not easy. However, I was able to build it to a place where when it was time to leave, when it was time to fire the man, I could do that and still had money in the business to grow it. And so I did that about 3 years ago and joined up with my business partner, Ken Wilson. And we started 80/20 Capital, which is a company that manages 3 Amazon brands right now.
So really, it goes back to your dad giving you that, renting that piece of land. He rented it to you, right? I mean, how old were you? You were 12.
I was 12. Yeah, I've got 2 young boys, 2 and 4. And this is a page I'm going to take out of my dad's book as I raise those kids. The school system is not going to teach people how to run a business. The school system is good at making employees. And we would sit down and we would look at the market rate per acre, and we would look at how much seeds would cost. And very early on, we had an income statement. I mean, that's what it was. And we would track our costs. And when we were feeling really busy and wanted to hire people, we would go back to, and it was just written out. But my dad spent some time with me and my younger brothers, kind of walking through, hey, this is how a business runs. And you've got your revenue, you've got your expenses, and you have your net income. And so, yeah, it started there. And as I raise my children, that's something I'm very interested in doing, is finding something that will teach them about business. And it's not necessarily about making money. It's about teaching them you can do this. You live in a country that supports entrepreneurs, and it's a great time to be an entrepreneur, and teach them kind of the fundamentals or underpinnings of business.
Well, what I find fascinating is your dad rented the land to you. He did not say, okay, here is some land, go do it, and here is how you make money, and blah, blah. He also put the responsibility on you to pay him rent.
Mm-hmm.
Did you ever think that, oh, it's just my dad, I don't have to pay if I cannot? Or did you actually take it 100% as a responsibility you must meet.
Yeah, I took it seriously as a responsibility, and that goes to probably my relationship with my dad. But when he said something, he meant it. If his goal was to teach his kids about business, he did a good job. And waiving rent would have probably been a disservice to us. And again, the thing here was not necessarily about making money, but it was about learning and just kind of learning some of the basics. And so, of course, like when we got seed, he would give us an interest-free loan, but we would keep track of receipts and how much the seed cost. And in the fall, we'd pay him back. And that was something that, yeah, that was really valuable, really valuable.
Did you ever have that discussion with your dad about, him charging you rent? And did you ever, at least jokingly, did you really have to charge?
No, the discussion I've had with him is, Dad, I've got two young boys. I grew up in Iowa where we had great soil. You put a seed on the ground in Iowa, it's going to grow. I live in Missouri where when it rains, rocks come out of the ground. It's not fertile soil. But I want to recreate something like that for my kiddos. So I've talked to him about like, what were some challenges? What, if you could do it differently, what would you do? But not necessarily on the rent piece. Probably at the time, maybe around age 16 when you're rebellious. I'm sure I probably had something to say about it, but really in hindsight, it was a great experience and something I was not getting in the school system. And it sounds dramatic, but it did change my life.
I mean, this is the experience and the wisdom that people have. And then growing up as kids, we don't really realize, but they do these things and they either make certain rules and make us do things, but really they were thinking 10 steps ahead and they knew the impact. These are experiences that really need to be celebrated, except that we don't think about these. And as yet, those are the things that make us who we are and then give us the kind of life we have, right?
Absolutely. Absolutely. Nick, before we change topics, I want to go grab something and show it to you.
Sure.
So just so you don't think I'm making all of this up.
Oh
Here.
my God. Pumpkin Patch Kid. For my listeners, David just showed me a framed newspaper, big newspaper article, and the heading is Pumpkin Patch Kid.
Yep. From October 2003. Yep. It was a great experience. And to anybody raising children, I'd encourage you to think about it.
I envy you. You know why, David? Because when I was a kid, I was a good student and I wanted to make money. And I wanted to play cards. And both my parents said, you're not going to make any money until you graduate from college. And you're not going to play cards. I'm not going to teach you how to play cards. Even backgammon, because backgammon was played with people where they also played cards. It was the place where people, until you graduate from college, because they were afraid that by making money, I would get a taste of money and give up my studies. And then by playing cards, I would end up hanging out in places where I would probably hang out with people not that they would approve. So as a result, I did not get a job or anything. In fact, when I started college, I started giving private tuition to kids. And that's when I started to make money. They were not happy with that. Of course, I did not. And I completed my studies. So your dad was so wise in giving you something that not only obviously put a whole career path in front of you, but also that strategic move about charging your rent. It immediately, it like instant boost of responsibility, sense of responsibility. It's a great story. And then you end up becoming the Pumpkin Patch Kids.
That's right. That's right.
That's great. So David, so tell us, how can people reach you, share your contact information with us?
Yeah, absolutely. So if people are interested in getting in touch with me, my email address is david at firingtheman, FIRINGTHEMAN.com, and have a podcast. We're in our 5th year, Firing the Man podcast. We put out a new episode every Tuesday where we're discussing all things e-commerce.
Great, great. I'm sure everybody will tune in. You must check out David's podcast. He's an Amazon seller. You saw how knowledgeable he is, and download, subscribe to it, and reach out. He's a super great guy, super nice guy. He is going to be more than helpful. Thank you, David. Thank you for being here.
Nick, thank you so much for the invite. This has been a lot of fun, and looking forward to staying in touch.
Yes, definitely will do. Before I go, a quick reminder to say goodbye to your cash flow problems and claim your extra $1,500 when you qualify for $25,000 or more in funding. Go to www.runviably.com/legends and start your application today. And this brings us to the end of another episode, and see you on the next one.
If you enjoyed today's episode, be sure to subscribe, rate, and review the episode, and share it with someone you think would benefit from it too.